Right. Good morning and welcome once again to series 3 of our discussion on risk management in strategic financial management. We have looked at the basic concept of foreign currency risk management. We have also looked at the hedging strategy for foreign currency risk management. Specifically, we have looked at the internet hedging technique in our session 1 of this video. We have also looked at forward contract. We started the futures contract in our session 2. However, we could not complete it. So let's take it off from there and discuss the remaining part of futures contracts. Of course, we also discuss money market hedge, even though we have not solved question on that. We're going to solve question on it. And then we also look at options contract, okay? Currency option, rather. We look at currency option. So without wasting time, let's dive straight to our discussion. Okay. Foreign currency risk management. Okay. Foreign currency risk management. And what we are discussing is currency futures contract. Currency futures contract. Currency futures contracts. Okay, so we have looked at the procedure for hedging using currency futures contracts. For the purpose of revision, let me quickly run through those procedures again. Procedures for hedging. Using currency futures. Okay, we said number 1 is to determine, we gave this one in series 2 of our discussion, to determine whether to buy or what? Or sell futures at the inception. At the inception. That is, when you want to enter into that hedging agreement, you need to be able to decide whether you're actually entering the market by buying or selling futures contracts. 2, we said you need to know the appropriate. Okay, sorry, let me conclude that. Let me conclude the first one. So what's the rule here? What's the rule here? We said the rule here is that for someone who has a foreign obligation, that is, you have a payment in that foreign country, what is you should do? We say you should enter by what? You know, we said there is a indirect relationship between futures price and the spot exchange rate. And we said if the exchange rate is going up, okay, if exchange rate is going up, we expect the futures price to drop, isn't it, in the future? So if I am having a foreign obligation, my fear is that the exchange rate will go up against me. If that is the case, it means I will enter the market. If exchange rate actually goes up in the future, it means the future will be cheaper, isn't it? I want to buy something when it is up, when it is cheaper to do so. So it means right now, I will enter the futures market by selling a futures contract. I will enter by selling futures contract so that if exchange rate does go up the way I have predicted it, then I can close out from that futures contract by buying the futures back cheaply. So my profit on the futures contract is the difference between the amount at which I've initially sold it and the amount at which I'm buying it back. So I'll be making a profit on the futures contract. However, because exchange rate has gone up, in the spot market, I'll be making a loss because I will have to convert that transaction at a higher rate. So I'll be making a loss on the spot market, but in the futures market, I'll be making a profit. So the profit on the futures market will be used to offset my loss in the spot market. Okay, that was our explanation yesterday. So for foreign obligation, you enter by what? By selling. Enter by selling. Sorry, 1 minute. Enter by selling futures. You enter by selling futures. But if it is a foreign asset, okay, you have an asset, foreign asset, that is, you have a receipt in that country. That's what we mean by foreign asset. For foreign asset, so you do the opposite. What's the opposite? You enter by buying futures contract. You enter by buying futures contract. Why? Because your expectation is that exchange rate will go down. If exchange rate does go down, the way you have predicted, it means the futures will be expensive in the market. The futures price is expected to go up since there is what? Inverse relationship between futures and the exchange rate, spot exchange rate. So you buy the futures now so that in the futures, if exchange rate actually goes down, the futures price will go up. You can sell it and make a profit. The selling price minus the buy price will give you the profit. However, in the spot market, you'll be making a loss. If you're making a loss in the spot market, the profits you make in the futures market will be used to offset your loss in the profit you make in the future market will be used to offset your loss in the spot market. Number two, when I say you should not determine how many what? How many contracts to, so which expiry, sorry. Which contract to buy or what? Or sell. Which contract to buy or sell. So what's the determining factor for this? You buy or sell contract. You buy or sell contract that matures. That mature. Okay, instead of mature, let me put expired. That expires immediately after your transaction date. Put it that way. after your transaction So don't forget, we said we have a 4 contract, the March contract, the June contract, September and what? And December contract. So if my exposure is in August, I have a liability or a receipt in August, the next contract I should buy should be what? The September contract. The December contract will be too far, while the June contract will be too early. Okay, so the contract you should buy or sell is the contract that matures immediately after your transaction date. Okay. Next, number 3 is how many contracts to buy or sell. How many contracts to buy or sell? What's the rule? Number of contracts, number of contracts, number of contracts is equal to your exposure over contract size. Exposure over contract size. That's how you get your number of contracts. Don't forget, we said if the hold on. For what we discussed in the previous video, section 2, we said if the exposure and the contract currency are not the same, so are not of the same currency. If the exposure, let's see this as H. If the exposure and contract size are not the same currency, the exposure must be converted to the contract currency using the opening futures price. Using the opening futures price. After you have done this, what's next? Number 4, you need to compute the profit or loss on the futures contracts. Then 5, determine the outcome. This is a revision. We did this in our last class, so I'm just reversing it so that you know where we stopped. So determine the outcome of the edge determine the outcome of the edge. Now, I also told you that you may also be asked to calculate edge efficiency. Abi, you may be asked to calculate edge efficiency. Edge efficiency is how effective your edge is. Okay, so but it's not uh, a requirement that comes always. Okay, it's not part of the procedure really. Computation of edge efficiency. Computation of edge efficiency. So the edge efficiency is calculated as profit on one deal over loss on the other deal. Loss on the other deal. What do we mean by deal here? I told you we have a when we are edging using futures contract, we are dealing with two markets. Don't forget, you are dealing with the spot market, you are dealing with the uh, futures market. So in the futures market, you may be making a loss. In the spot market, you may be making a profit. It may also be a reverse. You may be making a loss in the spot market while you are making a profit in the futures market. It's also it's a possibility. Okay, it's a possibility. If that is the case, whichever the deal that is giving you the what do you call it? Sorry, what's happening with this? Sorry, 1 minute. Sorry. Let me so as long as it is back now. Okay. Yeah. So if you are making a profit in one market, you should be making a loss in the other market. The two market cannot give you a profit at the same time, while they cannot give you loss at the same time. One must be giving you a loss, and the other one is giving you a profit. Okay. Now what's happening now? Sorry, 1 minute. It isn't going on enough like this. Okay. Mhm. Okay, so I think we're back now. We're back now. Sorry, 1 minute. Let me regularize this thing. Continue. Okay, I think, see what happened. Okay. So we said profit on one deal over what? Over loss on the other deal. That is our edge efficiency. That's our edge efficiency. Okay, so what do we do in a situation where what do you call it? In a situation where we are not given the closing futures price. Sometimes the examiner might not give you closing futures price, and you need the closing futures price in order to close out of this edge. Sorry, let me just save this one. I don't know why it's misbehaving. It's not giving what I want. Sorry, just save this one. Sorry, 1 minute. Let's save it normally. Stay. Note 4. Okay, so let's open another chapter, another note, rather. Very doing like this now. Something. Okay, so stick currency futures contracts, forget currency futures contracts. So we've written the formula for edge efficiency. I told you how it is calculated. So I said, okay, what about how to calculate closing really? Okay. How to calculate closing futures contract if not given. Now, you need opening futures contract. Sorry, opening futures price. Did I call it contract? Opening, closing futures price. Closing futures price. So you must have an opening futures price and a closing futures price, because you need to either enter by buying or selling, or you need to close by either buying or selling assets. So the price at which we are buying or selling initially is the opening futures price. The price at which we are buying or selling later, when we are closing out of that contract, is the closing futures price. So if not given, how do we calculate it? Now look at it. Let me go to that. So we have, look at it. Spot price. We all know what spot price is now. Spot price simply means the spot rate in the spot market. We have disagreed between two markets now, the spot market and the futures market. So the spot market, the rate there is the spot price, what we call the spot price here. Okay, and then we have the futures price. Now the difference between these two is what we call basis. Okay, is what we call basis. So the first thing you need to do is calculate the basis. Okay, calculate the basis at the beginning. Calculate the basis at the beginning of the futures contract. Calculate the basis at the beginning of the futures contract. How is this done? Now, what is basis first? Let me define basis. Basis is the difference. Basis is the difference between spot price and the futures price at the beginning. Okay, don't let me put at the beginning. Let's just put it here. The difference between the spot price and the futures price is basis. Now, we can say basis is equal to spot price minus futures price. Now, at the beginning of the contract, the spot price and the futures price will not be the same. Okay, the futures price and the spot will not be the same. For instance, the spot price may be, let's say, 95.00, and the futures price is 88.00. So that is basis. The difference between these two is the basis. Is the basis. So we say this is what is 7, right? Yes, 7.00. This will be the basis at the beginning of the contract. Now, as time passes by, okay, as the futures contract runs out on a daily basis, this basis, this 7, is expected to decline linearly. It's expected to decline linearly. We expect to be reducing systematically in equal proportion on a daily basis. Now, such that when the futures contract expires, the spot price should be equal to the futures price, meaning that basis should be equal to what? Should be equal to zero. Basis should be equal to zero when the futures contract expires. Okay? But at the beginning, when we enter into that futures contract, it will not be zero. Okay? It will not be zero. It will not be zero. So, because it is not zero, we need to estimate the basis when we enter into that transaction. Okay? Now, after you enter into that transaction, let's say your transaction date is July. Okay, this is your transaction date. Your transaction date is July. While your what do you call it? Your futures contract, the contract you enter into is the September futures contract. You enter into September futures contract. Futures contract expiry. Futures contract expiry. That's what we enter into. Now, you see that you are going to close out of these futures when? In July. Let's say July 31. This one is September what? 30th. So on July 31st, you are expected to close out of this futures contract because that is your transaction date. You can't leave the futures contract until it expires because your exposure is not July. It's not September. Therefore, you need to close out of the futures contract when your transaction expires. And since we still have how many months? We still have 2 months. We still have 2 months between your transaction date and your futures contract expiry date. Therefore, there's going to be okay. Sorry, just need to plug my laptop. It's running low. So since we still have 2 months, no, go back. Don't worry. Yeah. So you still have 2 months between your transaction date and the futures contract expiry date. Then there's going to be what? There's going to be what is called unexpired basis. Don't forget, I said futures should be what? Basis should be reducing a bit linearly. If the transaction date has not is not reached yet, the futures contract will still have unexpired basis. So you need to calculate the unexpired basis. Okay? You need to calculate the unexpired basis. Are we together? Okay, now the closing futures price closing futures price is equal to opening futures price minus plus or minus, sorry, see that plus or minus unexpired basis. plus or minus unexpired basis. Okay, plus or minus unexpired basis. That is how. Now this one here is also called the lock-in rates. Lock-in rates. Okay, this is also called lock-in rate. Lock-in rate means the rate at which you are going to close that transaction. That will give you your net receipt on that transaction date, or your net payment on the transaction date. Okay, so that is how you calculate your closing futures price if not given in the question. Okay, what else do we need to know here? Now, I think basically we are done. Then let's go to currency option contract. Currency option. Let me wipe this one off. Go up, go up. Let me erase this one. Let me do here. Okay. Currency option. Currency option. Now, currency option, like we remember we discussed a option pricing model. So for currency option, unlike futures and forward contract, currency option, as the name implies, gives the holder option, gives the holder option gives each holder the rights, but not the obligation, to buy or what? Or sell quantity, to buy or sell quantity of a currency. So I call it currency here because we are dealing with currency edge, foreign currency risk management. So I'm not saying underlying asset because our underlying asset, don't forget, in what we did in class, I said to buy or sell the underlying asset. But here, since our underlying asset is basically currency, we're not dealing with any other asset apart from currency. So that's why I'm specific here. Call it what? We want to buy or sell some quantity of a currency. So if I have a foreign liability, foreign receipt, I can use option to hedge. And one advantage of option contract is that you are not bound to honor that option. You have an option as the holder to buy or sell. I will only exercise my right if that option is favorable to me to do so. If it is unfavorable, I will simply allow the option to lapse and I go elsewhere to buy or sell my currency. Okay, so option does not tie you. It does not tie you to a particular rate. It allows you to take advantage of a favorable movement in exchange rate in the market, unlike futures and forward contracts. Okay, unlike futures and forward contracts. All right. So let's distinguish between two types of options. We have the over-the-counter Over-the-counter currency option. Currency option. Then we have exchange traded. Exchange traded. Currency. Exchange traded currency option. So if that's the case, when we say over the counter, like we talk about under forward contract, over the counter just means between two parties without a middleman. Okay, so this is not traded. This one is not traded. It's not traded. I can come to you and say, I can go to the bank for instance, I say, okay, I want us to agree a rate at which we sell dollar to me in the future. That's over the counter. No middleman is involved. It's not traded in the market. Okay. Now, exchange traded currency option. In this one, you have to buy the option from the option market. Just like you have the futures market, we have the option market. So if you are dealing with currency, exchange traded currency option, the option must be bought or sold from the option market. So whether over the counter or exchange traded, for you to have that right, you must pay what? You must pay premium. It's a premium that will give you the right to buy or sell the currency in the future period. So now, how do we hedge? Procedure for hedging. For hedging using currency option. Let me see, am I not missing it? Let me go to my notes so that I'm not missing anything. Let's go there. Okay. Over the counter, okay, to the currency option. Step in hedging, okay. Okay, good. Okay, that's the next one really. So one is that the procedure. Just wanted to be sure that I'm not missing anything. Procedures for hedging. Using currency option. Using currency option. Number one, determine whether a put or call option should be bought. You are buying here, not selling. Because you want to hedge, you are buying. I don't want to hedge. Should be bought. Now, what's the rule? If you have a foreign obligation, you have a foreign obligation to pay, foreign obligation, you have foreign obligation. So, foreign obligation means you need to buy the foreign currency, Abi? So, you buy put option. Buy put option. Now, put, come in, I'll explain this so that you don't cram the verbatim. When we have some question on HA traded, this rule will not apply dogmatically. So when I'm dealing with exchange traded option, for me to decide whether a put option or a call option is involved, I need to look at the contract currency. In an exchange traded option, is the contract currency that I can buy or sell. So look at it, the contract currency, what are you doing with it? And we elaborate on it when we solve question on exchange traded. Okay, so you have to see the contract currency. Am I selling that contract currency or am I buying it? That is when you know whether a put or a call option. But if it is over the counter, then that one there's no, it's not standardized. It's not standardized. I think I missed something. Don't worry. After this, I'll go back and explain that. So it's not standardized. For over the counter, it's not standardized. So it can be tailored to users, just like our forward contract. So in that case, you just look at your exposure to determine whether you are buying or whether a put or a call option is involved. Okay, so I will explain more that way we solve question. Then for foreign what? For foreign receipt. So you buy call option. Is call option, what did I say here? You want to buy here, right? Sorry. Nice. You want to buy the foreign currency to pay. So this is a put option. This is a put option. You want to buy the foreign currency in order to pay. So option to buy is a call option. Option to sell is a put option. So you want to buy the foreign currency, you want to buy dollar in order to pay. So option to buy is a call option. Here you have a foreign receipt where you collect the dollar, you're going to sell it. So you buy the right to sell, which is a put option. Okay. Now, because option contracts are standardized for exchange traded anyway, for exchange traded they are standardized. I'll go to second one. Because it is a standardized contract, if exchange traded option, if exchange traded option is used, determine the appropriate contract to buy. Determine the appropriate contract to buy. So just like your futures contract, exchange traded option we have four contracts. Okay, the March contract, June contract, September contract, and the December contract. What that means is that option contract, just like futures, expired every 3 months. Okay, it expires every 3 months. So the rule is that you buy contracts that matures immediately after your transaction date. Immediately after your transaction date. Okay, you buy contract that matures immediately after your transaction date. Now go to the next one. How many contracts to buy? How many contracts to buy? So number of contracts to be equal to exposure over contract size. So just like in futures, if the exposure and the contract size are not of the same currency, not of the same currency, the exposure must be converted to the contract currency using the appropriate exercise price. Using the appropriate exercise price. Okay, so next, you need to choose the appropriate exercise price. Choose the appropriate exercise price and the corresponding premium premium. Then 5, calculate the premium, the total premium payable. Don't forget, premium is upfront. You pay premium immediately. Calculate the total premium payable. Then 6, compute the outcome of the hedge. So to properly understand this, right, we need to actually take a question or to properly grasp this whole concept of currency future and the like. So let's go and take a question. And this one just up there, you know where this one is going continuously. Okay. Let's go and take our question. We have taken question number 1 already. Question 2. Question 2. Let us take question 2. Question 2. Okay. Alpha PSC is a Nigerian manufacturer of plastic containers, which it sells in many markets, in many West African and other African countries. In 3 months' time, Alpha PSC is due to receive 70 million kudi from a country in Central Africa whose currency is Kudi. At a board meeting slated for today, the directors will be discussing whether or not there is a need to hedge the foreign exchange exposure associated with this transaction, and if so, how best this might be achieved. At the board meeting, three possible alternatives will be considered. One, not to hedge this transaction. Two, use a forward contract. Exchange rate quoted by Alpha PSC Bank today are spot 1.1548 to 1.1608 Kudi to 1 naira, and 3-month forward 1.1438 to 1.1508 Kudi to 1 naira. Use an over-the-counter currency option. Consider over the counter. This is not traded. This is not an exchange traded. Although I'm considering using what? Over the counter. Over the counter. Okay, we are using over the counter currency option. Okay, let's continue. Okay, use an over the counter currency option on Kudi, which is available through Alpha PSC Bank. Current premium at an exercise price of 1.1650 Kudi to 1 naira at 1.1 per 100 naira 100 Kudi for a call option and 1.25 per 100 Kudi for a put option. So required. State four reasons why a firm might reasonably choose not to hedge its exposure to exchange rate risk. B, show the effect of each of the three alternatives being considered, assuming that the spot exchange rate in 3 months time is 1.1850, 1.1 to 1.188, then 2, 1.1295 to 1.132, and C, state four method available to firm to reduce the exposure to that question is not complete. It should be state four method available to firm to reduce the exposure to foreign exchange risk, which do not involve the use of financial contract. Okay, financial contract. Let's go and solve this. What's the name? Alpha PSC. Alpha PSC. Alpha PSC. Alpha PSC. So, let's say question what? Question 2, page C119. Am I correct? Yeah. I think we have just 119. Okay. Question 2, page 119. Question 2, page 119. So A, reasons why a company may choose not to hedge. Reason why a company may choose not to hedge. One, a company may choose not to hedge if the cost of hedging is more than the benefit. Cost-benefit analysis, okay? Cost is an important consideration when you are determining whether to hedge or not, okay? Cost is very important, okay? So, cost of hedging, if cost of hedging is more significant a company may choose not to hedge. That's one. Two, a company may choose not to hedge if you look at the materiality of the exposure. If my exposure is small compared to the size of my whole transaction, I may choose not to hedge. Maybe my whole foreign, my whole transaction is 5 billion naira, and my foreign exposure is just like, let me say, 5,000 or 10,000 or even $100,000. So you see that the materiality is what is not there. That exposure is not material, considering the size of my transaction. So I may choose not to hedge. Okay. So if the size of the exposure is small, if the size of the exposure is small compared to the size of the whole transaction of the company. That's another reason why a company may not hedge. Number three is the attitude to risk. Your attitude to risk may also determine whether you are going to hedge your transaction or not. If you are a risk taker, you may decide not to hedge. Yeah, you are taking a risk that, exchange may move in my favor. So your attitude towards risk may decide whether you are hedging or not. People that have low attitude, risk, what do you call it? Risk averse individual will hedge their exposure, while risk taker individual may decide not to hedge. Okay, you just think, let me try my luck. Okay, so you are taking a risk. So your attitude will decide whether you hedge or not. That's number three. Um, attitude of the company towards risk will determine whether the company will hedge or not. Whether the company will hedge or not. Now, another reason why a company may decide not to hedge is if shareholders are already well diversified. Shareholders have diversified their unsystematic risk away. So the company may decide not to hedge because shareholders are already diversified. Okay? If the majority shareholders of the company are fully diversified, or let me say, have fully diversified portfolio. Have fully diversified portfolio. Sorry, 1 minute. Let me check. All right, so these are the reasons why a company may choose not to hedge its exposure to foreign currency. What's the next requirement? Next requirement is to show the effect of each of the three alternatives. Okay? Effect of the three alternatives. What's the alternative one? Alternative one is not to hedge. Not to hedge. If we decide not to hedge, what happens? Okay? So B, effect of the three alternative hedging methods. Alternative hedging method. So the first method is what? Is not to hedge. It's not to hedge. So one, we are saying we don't want to hedge, not to hedge. If the company has decided not to hedge, let's see what will happen. What will happen? Look at the current spot rate. What's the current spot rate? This is the current spot rate. That's the current spot rate. But what is the rate at the transaction date? Look at it. On that transaction date, the rate has moved to this, or it has moved to what? So we have two scenarios. Now, we have to go back to the question and see, what are we actually doing? Do we have a receipt of payment? We have a receipt of how much? A receipt of 5 minutes. A receipt of 70 million kudi. Receipt of 70 million kudi. 70 million kudi. So when we receive this 70 million kudi, where's our company? Our company is in Nigeria. When we receive kudi, we need to what? We need to sell it. We need to sell it in order to get naira because we spend naira in Nigeria. So come to think about it. Considering this rate, let's talk about the spot rate first. You know, it's kudi. Is kudi to naira. The exchange rate is kudi to 1 naira. So 1.158, 1.1548 to 1.1608 kudi to 1 naira. Now, we talk about bid ask price. The 1.1548 here is the bid price. 1.1608 is the offer price. Okay? Now, but we are not converting at this because our transaction is taking place in 3 months' time. And in 3 months' time, our exchange rate has moved to what? Our exchange rate has moved to 1.185 to 1.188 or 1.129. Now, the bank will say, okay, you want to sell 70 million kudi to me. But what is the exchange rate? Exchange rate is stated in kudi, Abi. So what we're going to do now is to look at, okay, let me ask. This is an indirect quote, right? Don't forget, we talk about direct and indirect quote. This an indirect quote because the foreign currency comes before the naira, right? This is an indirect quote. So you need to be careful when you're interpreting this type of question. This is an indirect quote. That's why I said fundamental knowledge you need to have before you can solve question on hedging is to know how to treat a direct quotation from indirect quotation. So this is a direct quotation. And my currency is also in Kudi. The selling price is Kudi. My exposure is also what? Kudi. So what do I need to do? I'll go and check. What am I buying? I want to buy Naira. That's it. That's what it means. I have Kudi. I want to exchange the Kudi to Naira, isn't it? So I want to buy Naira using the Kudi I have. So what will the bank do? The bank will offer you the Naira. That is the reason why what price we apply here is 1.188. So the bank will not bid the Kudi from you because the bank is not selling Kudi to you. The bank is what? The bank is buying Kudi from you. By what? Selling Naira to you. So to sell Naira to you, the bank will offer you the Naira. And don't forget, the offer price should be the higher price. Okay? The offer price should be the higher price. So let's go and see. We have 1.18 scenario 1, 1.188 scenario 2, 1.132. Okay. So scenario 1, scenario 1, scenario 2. What do you call it? 3-month spot price. 3-month spot price. 1.1880, 1.1320. Am I correct? Let me go and check that. Is that correct? 1.132, 1.1. Okay, yeah. And what is that? Don't forget this what? This is Kudi. Please take note. This is Kudi. Then what's our exposure? Our exposure is also what? It's a receipt. Our receipt is receipt, and it's also in what? In Kudi. And what's it? 70 million. 70 million. So what do I need to do? Because we are dealing with the same currency, I need to divide. So take note. When we are converting, the same currency divide, different currency multiply. Our exposure is Kudi, our exchange rate is also in Kudi. So I will now say, okay, the Naira receipt, okay, Naira receipt. So let's divide. Naira receipt, let us divide. We have 770 divided by 1.188, 58.922, 58.922. 58.922 million. 70 divided by 1.132. 61.837 million. 61.837 million. $61.837 million. That's requirement 1. It's not more than this. It's not more than this. It's not more than this. Okay. You may want to calculate the what do you call it? The profit or loss. So if you want to do that, just compare this one with what we could have done if we had paid the money immediately instead of waiting until 3 months time. So I'm not going to do that here. Number two. We also want to use forward contract, right? Yes, forward contract. We want to use forward contracts. Now, what's the 3-month forward rate? We have agreed this rate, 3-month forward. We have agreed 1.1508. Okay, that's what we have agreed, 1.1508. So If we have agreed, we want to use forward contract. Forward contract. If you're using forward contracts, we have two scenarios. Scenario one, okay, let me extend it a little. Let me extend it a little. Let me say scenario one here. Scenario two. Scenario one, scenario two. Okay, so our exposure in Kudi is 70.00. 70.00. That's our exposure. Now, 3-month forward rate. 3-month forward rate. The 3-month forward rate we have agreed is okay. We have agreed 1.1508. 1.1508. 1.1508. 1.1508. So let us convert. So Naira receipt, net Naira receipt, net Naira receipt, 70 divided by 1.1508, 60.827 million, 60.827 million. This is what we have agreed. Okay, this is what we have agreed. But now, in 3 months' time, the rate has gone to what? The rate has gone to 1.188, 1.132, 1.188, 1.32. So I will not say without edge. At DB, we did not edge. Without edge, if we did not edge. 1, 2. Exposure. If we did not edge, we have 70.00, 70.00. So our spot rate, 3-month spot rate, as 3 months. Don't forget, if we did not edge, you cannot use forward rate. You can only use forward rate if you have LUC forward contract. Now, you did not use forward rate. If you did not use forward rate, you have to convert at the rate on your transaction date, which is the spot rate. You can see the spot rate on the transaction date, 1.180, 1.132. I think we did that before, right? 1.188, 1.132. So, what do we have? Naira receipt. Net Naira. Net Naira receipt. Let me see. I think we have it up there. Yes, 58.922. $58.922 and what? 61.837. 1.837 million. So what is the gain or loss? What is the gain or loss? Now, I hedge using forward contract. Therefore, I receive 80.827. If I did not hedge, I would have received 58.922. So what's the gain? I gain it. That is the gain is 60.827 minus 58.922. 58.922. That is 1.905. We gain 1.905 million. Then here, I use forward contract, I receive 60.827. But if I did not hedge, I would have received 61.837. So I'm losing. What's the loss? 60.827 minus 61.837. What's the loss? 1.01 million. Loss. So that's the result of the forward contract. That's the result of the forward contract. This examination standard question, you can see this past question is no more than this. Hedging is not actually difficult if you can dedicate your time to get the concept right. And of course, it's a repeated question, like I told you. It's a repeated question. So if you understand hedging, it's assumed you already have one question at hand. Okay. So let's go to the next one, which is number 3, which is what? Using that's that one. Using option, right? Using option. Currency option contract. Okay, currency option contract. Use an over-the-counter currency option or KUDI, which is available through Alpha PSC Bank. Current premium at an exercise price of 1.18. Now, let's go and see that. We want to use currency option contract. But don't forget, this is over the counter. I told you we have what? We have exchange traded, we have over the counter. Over the counter is very easy to do than exchange traded. So exchange traded could be nasty really, but that is not to scare you. It's not just short. What's our exposure? Our exposure is that we want to receive. That's a receipt of what? Receipt of 70 million KUDI. Receipt of what? 70 million KUDI. $70 million KUDI. So what will I be doing if I receive this 70 million KUDI? I will be what? I will be selling it. So which option will I buy? We need a put option. We need to buy put option. To enable us, you don't need to write this grammar in the exam. I'm only writing it so that you understand what I'm doing. We need to buy put option to enable us to sell KUDI in 3 months' time. So in the exam, I'll just say buy put option to sell KUDI in 3 months. That's all. So now I don't need to know the number of contract because it's not traded. So I'll just go back in and see what is the exercise price. Current premium at an exercise price of 1.16. So our exercise price is what? 1.16. So exercise price 1.1, 1.165, 1.165, 1.165, 1.165. 1.1650. 1.1650. That's our exercise price. Now, we need to pay premium. We are paying premium. So let's calculate our total premium that we need to pay. Premium is upfront. You are paying premium immediately. So let's go then. What's the premium? And current premium at an exercise price of 1.165 kudi to Naira are 1.1 per 100 kudi for a call option and what? 1.25 per 100 kudi for a put option. We are not using call option, we are using put option. So the appropriate premium is what? 1.125. That's the premium. But it's what? A multiple of 100 kudi. So what's going to be the total premium? My total premium is 1.25, right? Let me go and check again. 1.25, yes. 1.25 multiplied by how many kudi do we have? 700 million kudi. 700 million kudi. Divide by what? 100, because it's a multiple of 100. A multiple of 100. So let's see. We have 700 million, 700, 123, 123, divided by 100, multiplied by 1.25. So 8,750,000. 8 million. I'm coming. Let me check this. Is it 70 million? Okay. I think I made a mistake. It's 70 million, not 700 million. 70 million. Our exposure is 70 million, could not 700 million. 70 million divided by 100. So we have 70, 123, 123 divided by 100 times 1.25. 875,000 is our premium. Now, that premium is paid up front, so and it's not refundable. We collect from our option pricing model plus codes, okay? And the next thing you need to decide is whether to exercise the right or not. Whether to exercise the right or not. Now, let's see. 1, 2. What is the spot price in 3 months? 1.188 spot price. Spot price 1.188, and this is what? 1.132. 1.1320. 1.1320. That's the spot price. What is the exercise price? What is the exercise price? 1.1650. 1.1650. 1.1650. Now, we have agreed that I will buy Naira at 1.165. 1.165. But In 3 months' time, the selling price of Naira is actually 1.188 and what? 1.132. So should I exercise my right? You ask yourself question. Exercise? Should we exercise? So ask yourself question. Should we exercise? I can buy at 1.16 and you are telling me to buy at 1.188. If I want to buy today without the option, well, you asked me why am I using buy? Let's go back to the question. You see, because the selling price, you know, we are actually come here, go there. Let me see. Um, so look at it. Look at the rates. You know, normally we say put option, abi? Option to sell. You are selling the kudi to get naira, abi? But what is the price? The price is also in kudi. If this is confusing, what you can do is just to convert it to direct quote. Now here, the interpretation of this is we have agreed that if I give the bank 1.1650 kudi, I will collect one naira. But in 3 months' time, the rate has gone to, before I can get 1 naira from the market, if I'm not using the option, if I want to get 1 naira from the market, I will have to spend 1.188. So I will give 1.188. I will give 1.188. I will give 1.188 kudi to get 1 naira. But I've already agreed with someone that I will give 1.165 to get 1 naira. Which one is better? You can see that this one is better. So, sorry, 1 minute. Let me quickly pick this call. So here, sorry. Yes. Okay, Mumbo.